Welcome to the 2026 Property Market Outlook. My name is Tim Gaspar and I am the Head of Lending at FMD. I joined the firm about 6 months ago. Some of you may have seen my name on emails and communications that have come out in that time. My background is that I was running a finance broking business for the last 20 plus years, and earlier this year decided to merge it in with FMD Financial and head up the lending division for them. My background in finance has largely been residential and consumer lending, and what I love about what I do is not the numbers and not dealing with banks, but sitting down with clients and helping them to set goals and achieve them, starting with buying a first home and then moving forward from there into a myriad of other goals. I'm joined today by David McMillan from Performance Property Advisory. David will be talking first today, but by way of introduction, he's the co-founder of Performance Property Advisory. He's been in the industry for 25 plus years, and he does a lot of work with high net worth individuals, family offices and financial advisors in devising property strategies that lead to long-term sustainable growth and results. He's no stranger to FMD, having spoken at a number of FMD events in the past. And on that note, I'm going to pass over to David to talk about the property market as he sees it.
Thank you. So we'll just start with a pretty broad market update. I've already received an intro, so thank you, Tim, for that. Just move through the next one, please, mate. Okay, so what we do is we take clients through their various life stages. And most clients, typically, not all clients, but they go through these stages of trying to purchase a home and then pay that home off. Then usually they'll upgrade their home and they'll try and pay that home off. And once the sort of the dream home or the final principal place of residence is paid off, then the focus is on building a portfolio. Now, that's not exclusively a real estate portfolio. Obviously, FMD will do all the wealth planning. What we do is we do the property side. And through all these major life stages or key life stages, the property strategies will be slightly different. And so what we educate our clients on is how to navigate through those stages. If we can go to the next slide, please. The most important thing the most important thing with any property decision is the property strategy. And a lot of people think all property is the same, which it isn't. And what we do before we buy anything is we put property into two baskets. The first one is we are going to buy this property to sell it in the future for a profit, which is what we call a trading asset. And the second type of asset is a foundation asset, which we're going to buy this asset, we're never going to sell it. And the purpose of holding it is for growth, or the purpose of holding it is for balanced, or the purpose of holding it is for income. Growth properties are usually residential houses or units. Balanced assets are usually unit blocks of units. And income property is usually commercial property, factory, warehouse, office building, etc. Most clients, 80% of our clients, are doing the trading strategy. They're buying in a market that shows value for $1 million, for instance, and then they're selling out of that market when it's fully priced for $2 million, for instance. And what they do with that net gain, after they pay the CGT and costs, it'll be around $700,000 in that example. What they do with that net gain is usually pay off their principal place of residence. So we've been doing this as a business for 13 years. The business started as a research company before it became a real estate company. We do this personally. We do it for over 2,000 clients actively. And what we do is we catch up with our clients every 12 months to review their circumstances, to review what's happening in the property market, and then we're giving advice. So the advice could be to buy some assets, the advice could be to sell some assets, the advice could be to renovate some assets. And that depends on what the market's doing, and it depends on what the client's circumstances are. So next slide, please, Tim. So our experience, we were established in 2013, just really quickly. We're established, if you go back one, mate, sorry. Yep. We established in 2013. We manage over $4.5 billion. We've got 100 staff, and we're sort of specialists in that high net worth medical profession and business owner space. All right, let's get into the market update because I'm sure that's what most people want to hear. So since COVID, and if you recall during COVID, most experts or a lot of experts and including a lot of journalists were quoting all sorts of figures such as the market's going to fall 40%, the market's going to fall 30%. And this is what happened from May 2020 to now. So all major markets went up. Some markets went up more than others. We were on record early, and I remember speaking to Lee Wappling about this, that we thought the market was going to run pretty hard because credit was cheap and we're undersupplied. And people, doesn't matter if COVID's around or not, have to live somewhere. It doesn't change anything. And certainly, if you understood the fundamentals of real estate and you're empowered by that thinking, you could have made some really good decisions during that time. And I think the first and most important thing is never listen to what you're reading in the papers. It's almost always wrong and almost always the opposite of how you should be thinking about a market. And I think a critical example of that right now is Melbourne. The mood in Melbourne is pretty average. And not a lot of business confidence, not a lot of people in the city, office vacancy rates at 20%, etc. But Melbourne is actually an area of focus for us right now. We've begun buying in Melbourne, and we'll buy a lot more in Melbourne over the next 24 months because it's a classic counter-cyclical opportunity for our clients. If we can go to the next slide. Okay, so here's the property clock for those that haven't seen it before. Usually what happens is markets, if they're in the buy value stage, will run in price for 6 to 9 years. Growth could be anywhere from 50 to 150%, depending on the macroeconomic cycle. Eventually what happens is when property prices rise far enough, it gets so expensive that the local population can't afford its own real estate. I'll give you a really practical example. So we bought over 1,000 houses in Adelaide 2016, 17, 18. We are now selling out of Adelaide currently. We bought a house, something that sold on the weekend. We bought a house for $550 in Adelaide. And last week, the same house, we didn't do anything to it, sold for $1.5 million. And I think we bought it, I can't remember whether it was 2017 or 18, but the property market over in Adelaide has had an incredible run. We got in when the market was cheap. We saw that demand was going to exceed supply. Market has run, and now it's becoming fully priced. But the papers in Adelaide right now are saying the Adelaide market's, the best it's ever been. It's more expensive than Melbourne. Investors are coming in, et cetera, et cetera, et cetera. So, the trick is to understand firstly how markets operate and then also have a strategy. So going back to that very first slide that I showed you, for our clients in Adelaide, we're very clear about what we're doing. We're going in when the market's cheap. We're selling out when it's fully priced. And those capital gains, we're going to pay the capital gains tax and we're going to use the net proceeds to pay off your mortgage or to actually pool your wealth to buy a home in Melbourne or to pay off a holiday home or whatever it might be. Everyone's slightly different, but the intent is clear before we go in. On the left clock is houses and the right clock is units. And as you can see, there's clearly more value in units at the moment than there is in houses. And that's because this coming cycle will be defined by an accommodation crunch. And because building costs are so expensive, we're really going to move into an undersupplied bedrooms. Rents are going to go up. And, the opportunity in this cycle is going to be more around units than around houses, whereas where the opportunity has been historically. When a market does peak, usually what happens is it spends 4 to 7 years in stagnation, unless it's what we call a workforce market. So a workforce market are markets that run in price when there's a lot of work on in those markets. So classic example is Perth as a city, but you get Darwin, Gladstone, Townsville, any mining service, commodity town, defence town. These typically go through big boom bust cycles. It doesn't mean to say that you shouldn't buy there. They are very much riskier than the capital cities, but it doesn't mean there's no opportunity there. If you understand how the market works, you do the work researching the market, you can take a view and you can make good money. But again, you've got to have that overarching strategy. Okay, we're buying a unit, for example, in Darwin at the moment for 300 grand. Once it hits that price trigger of 550, we're out. We're selling out, right? Darwin units are at the bottom of the cycle. We're buying units in Darwin cheaper than 17 years ago. There's a big defence push up in Darwin, obviously because of what's happening worldwide. There's $30 billion of government committed infrastructure. The population base in Perth is 150. They need 20,000 workers just to get this thing moving. So Darwin, demand's going to exceed supply. Property's cheap. It's a great trading option for those clients that have that risk tolerance. We'll move on to the next slide. So this is a different way of interpreting the clock. This shows how much growth we think a market has, and it also shows how much demand a market has relative to the demand pressure that's in other markets. So what this graph says here is Gladstone has 100% growth ahead of it for houses. It also says Greater Perth is the highest, together with Brisbane, is the highest in demand place in the country. So what you find with Perth and Brisbane, record low stock volumes, never been less stock, property selling in 2 or 3 days, property selling before they hit the market, double-digit price growth. These markets are really hot right now. What you find with Gladstone is there's a lot of growth ahead of it, but the market as it stands isn't that hot, right? It's not, demand definitely exceeds supply, but property may take a month to sell, 20 days to sell. There could be 2 or 3, 4 bidders as opposed to Perth, which will have 15 bidders on every property right now. So this graph and the graph before it is part of our data program, which we've been running for 15 years. And the data program, we've invested collectively probably $7 million into a proprietary way of extracting data every 30 days from all the various sources, calculating it using various formulas, and then we're recasting our forecast every 30 days. And once you understand what the markets are going to do and you understand your personal circumstances, then you can make what we call a 12-month plan, which is what are we going to do in the next 12 months to capitalize on the information that we have at our fingertips. And then once you make that decision, then of course you got to go out and buy something or sell something. And that's what our business does. We have buyer agents, we have vendor advocates. And of course, along the way, we've got to manage that property. So we manage properties as well. This is what we call demand runway for houses. On the following page, Tim, if you don't mind, is the demand runway for units. And as you can see, there's a lot more units in that blue quadrant, which is exactly where you want to be focusing. You want to be focusing in markets that have high demand and high runway if you want to get in and get out for a profit. So those markets are Perth, Rockhampton, Cairns, Bunbury. They're not the sexiest markets, but, a lot of people say to me, oh, I love buying property. But, ask someone who has been holding a unit in South Yarra for 15 years and made money. Ask them if they still love property. The answer is probably no. What people love is making money through property. And the way you make money through property is to have a really good, sound strategy. Now, the old strategy used to be buy, hold, never sell. And that probably used to work well when yields were 6% and the properties were cash flow neutral, cash flow positive. But that's not how property operates anymore. Property is negatively geared. And unless you're getting growth, this is residential property. Unless you're getting growth, it's a waste of time. And so you really need to be a bit more strategic than what the investors were that came before us. Certainly those investors that came through in the 80s and 90s, it's a more challenging game than what it was. I will touch on Melbourne for a moment. So if you can go to the next slides, because I know a lot of investors are in Melbourne. So as I said earlier, we are buying in Melbourne. The reason why we're buying in Melbourne is because Melbourne has gone through a correction. Prices in Melbourne from a house perspective are 10% up where they were in 2018. That is a 7-year, what we would call a 7 to 8 year correction. And the last time we had a 7 to 8 year correction was between 1989 and 1997. And that was, the recession we had to have. That was the 90s. That was a really bad era for Victoria. But since then, the Victoria market went on an amazing run in prices, right? So we're going through this correction. And, I don't want to use Paul Keating's word, but it's almost a correction we had to have for various reasons. And now the market is bottoming out, and now no one's building in Melbourne, and no one's building in Melbourne because they can't make money, but the population is still coming. And the population is highly likely to keep coming because we're a highly desirable place to live from an international standpoint, right? Lately, we've been losing to interstate migration, but usually when things are swing full circle, we're not interstate losers, we're interstate gainers as well as net overseas gainers. So the population is coming, yet the real estate prices are coming back And that means the debt to income figures are resetting. It means the affordability index is resetting. It means property is starting to become within reach and affordable for the first home buyer again, especially for units. You know, as I mentioned before, South Yarra units are almost as cheap as they were 15 years ago in certain instances. So we're very hot on units at the moment from a trading perspective. So buy and sell for a profit. And we're very optimistic about Melbourne in general. So we're telling our clients who are looking to upgrade, now's a really good time to upgrade. And if those people are trying to get into their first home, now's also a really good time to get in for your first home. I'm not saying the market's definitely going to grow next year. I'm saying counter-cyclically, it's a good time. It may start growing next year depending on other factors such as interest rates and government policy. But it is a good time in general to start laying some capital in this market, and we'll probably buy, you know, maybe $300 to $400 million of real estate in Melbourne next year on behalf of our investors. Next slide, Tim. To just highlight that point. We're still going?
Yeah, it's just...
Has it stuck?
Yeah.
There we are. So to highlight the point of why no one's building in Melbourne, it's because the black line there, which is the building indices, and the blue line, which is house prices, you know, build costs have gone up and house prices have gone down. What does that mean? Developers can't make a profit. So what are developers doing in Melbourne? Nothing. So if developers are doing nothing, what does that mean? No bedrooms are being built. So if no bedrooms are being built, but the population is still coming in, the vacancy rate must go down, which it is, and rents will start to go up, and they'll start to go up faster. So we'll see single-digit growth this year, most likely single-digit growth next year in rents, but the year after, 3 years from today, we're probably going to see aggressive rental growth. And the papers here are going to be, you know, as loud as possible about a rental crisis, accommodation crisis, homelessness issues, etc. That's already happening in other states. But Victoria, it's gonna happen, and it's gonna be really loud, and you're gonna know about it. So no one's building anything because it's not profitable to do so. That's a good thing for future house price growth. That's my 15 minutes, Tim, but I've got 2 more slides, and then I'm done, just to stay on track. And as you can see, to highlight my point, this is dwelling approvals and dwelling commencements in Melbourne. We're building less and less and less and less and less, and it's a problem. It's a problem from the standpoint of the only thing that can happen is we can have lower vacancies and higher rents, which is a good thing if you're an investor, and it's a good thing if you want to put some capital into the Melbourne market. I think there's one more slide. And as you can see, the population keeps coming. So the blue line there is the black line is net overseas migrants. The blue line is natural births, and the grey is interstate migration. So you can see that usually we're an interstate migration winner, but we've started being neutral and losing interstate migrations in the last 5 years. And if you go back to the most comparable period was the 90s. In the early 90s, we also lost a lot to interstate, and that was also the period when our house prices were flat, right? So what we're saying is we think that the net migration interstate flows are over, and you're going to have high population growth against no bedroom production in a market that hasn't grown in 8 years. So these are typically the conditions we look for to invest in. And we're pretty excited about that because it's the first time we've bought in Melbourne since we've started the business, and the business is based in Melbourne. So on that note, Tim, I'll hand it back to you.
Thanks, David. Thanks for sharing your insights there. For the next section, I'm going to head in a slightly different direction. I'm going to look more at the funding side, and in particular, what sort of help is out there to help first home buyers get into the market, because it's the subject of constant debate and discussion. How do we make housing affordable for first home buyers? And I'm going to focus on 2 main areas. One is the government assistance that's available, and the second is the family assistance, or the Bank of Mum and Dad, as it's more commonly known as. And there are 4 main government programs that I'll have a quick chat through, and then corresponding to that, 4 areas where families can help: gifting money, lending money, something called the Family Guarantee, and education. And I've highlighted that because I wanted to start there. Teaching kids and then they become adults, good money and finance habits is really vital towards helping them along their journey in life. And I'm not talking about war stories from Uncle Jack about when he was a kid and he bought his first home in 1990, but sharing up-to-date current information and wisdom. And David touched on some of that earlier in terms of the view of property as an asset and as a way to grow wealth. The education that we as a family can give is really vital, and that includes giving people in our family access to advisors, whether they be property advisors, financial advisors, conveyancers, building inspectors. It takes a team to buy property, and that's something to keep in mind as you try to help your children get into the property market. Moving on, so I want to talk about government assistance. And when I bought my first house, the main form of government assistance was the First Homeowners Grant, and it was available to people. It was $7,000. And that program still exists in a slightly different form, but by far and away the most common program being utilised these days is the 5% deposit scheme, also known until recently as the First Home Guarantee Scheme. What the scheme does is that it allows a first home buyer to borrow up to 95% of the purchase price of a property without incurring mortgage insurance. So it saves the buyer a significant sum of money, perhaps up to $40,000 in costs. It means that they need less savings to get into the market, which means invariably that they can get in there 1 to 5 years sooner. And then it also means that because mortgage insurance doesn't apply, lender policies are more favourable and interest rates are also typically more favourable. So to qualify for the program, all a buyer needs is 5% genuine savings, and they need to be able to cover that 5% plus any additional costs. There is no longer an income test, and that is a change that occurred this year. And there are price caps. So the properties need to be within certain price caps. And in Melbourne, that is up to $950. In regional Victoria, it's up to $650. And I've included some figures for South Australia if we have some South Australia viewers online. Other than that, the buyers must be Australian citizens or permanent residents, and they must intend on living in the property to take advantage of the program. Just quickly, there are stamp duty concessions in Victoria on properties, no stamp duty under $600,000 at all, and concessional stamp duty between $600,000 and $750,000. And that can save a first home buyer up to around $30,000. If they're buying brand new properties or off the plan or building, then there is a government grant still of $10,000. That's the old First Homeowners Grant. And the last government program to touch on is the Super Saver Scheme. And what this scheme is ideally suited to is someone who is really clear that they're going to buy a home. They may be planning 1 to 3 years out and have some time to start to put extra money into super in that interim period. They can contribute up to $15,000 a year or $50,000 in total. And in doing so, they are in effect saving tax in the process, which is what makes it attractive. And where I've seen this used well are first home buyers who may be living at home, not paying rent, earning somewhere between $60,000 and $120,000 and able to make those extra contributions to super and build up their savings. So in really quick time, they're the 4 main forms of government assistance available. And I wanted to talk now about family assistance. And I guess the most common and well-known is gifting money to first home buyers. And it's attractive to many families for its simplicity and for the fact that it doesn't impact the borrowing capacity of the borrower compared to the next option. The challenge, though, is that not every family can afford to gift money. And gifters need to be aware of the Centrelink implications of gifting money if they're on government pensions. And then this isn't a negative on it, but it's certainly something to keep in mind, is family dynamics. If you've got two or more kids, what you do for one kid, you probably have to do for all the others. And then what if your relationship with the child breaks down? How does that gift sit? And there's obviously a lot of emotional and relationship challenges that come with that. The next option is just a step to the left. It's lending money to children rather than gifting it to them. It can be done and documented in a way that should they be in a relationship and that relationship end, the money that you've given your child may be protected against the risk that there's a claim on it from the ex-partner, and that is one of the risks with gifting. And you can set up the lending with very flexible terms. So it may be that it's a low interest rate, it may be that there's no interest rate, and it may be that the loan doesn't need to be repaid until the property is sold or the home loan with the bank is paid off. The things you need to be aware of in lending money is that if there are repayments due whilst there is a bank loan on foot, it will impact the borrowing capacity that the children will have with their bank. And obviously, if the loan's not being repaid, it's going to place a strain on relationships. And there may be tax implications you should talk about with your advisor. The next one, and the main focus really, is family guarantees. So first of all, what is a family guarantee? It's where a parent offers a property that they own as a joint security for the loan that the child seeks when they buy a home. The value of a family guarantee is that it typically means that the first home buyer needs less savings or funds to make a purchase. The strength of it as an option is that their parents don't need to have cash to give, they just need to have equity in property. So it will suit a family that are asset rich and cash poor. This strategy will allow the first home buyer to avoid mortgage insurance, and that can be a really significant saving, as I'll show you in an example that follows. And it can mean that the first home buyer can literally borrow 100% of the purchase price and costs and not need any savings at all to get underway. The things to be aware of with this approach is that the guarantee doesn't allow a first home buyer to borrow more than they could otherwise afford. So the parent's income is not a consideration in this scenario. You need to be aware that if the property you put up as security is at risk, if the first home buyers aren't making the repayments and the bank has to step in, they're going to look to the guarantors to make the repayments or to sell the home to be able to clear the debt. If the parents still need to have borrowings of their own, that can affect their borrowing capacity. And when things don't go well, obviously there's always the relationship damage that is done. So I wanted to take you through a quick example to demonstrate how this can really help first home buyers. We had a young couple who were each earning $135,000. They had $150,000 in savings, so they'd made a really good start. And they had $100,000 in HEX debt, but no other debts. We worked out they could borrow a bit over $1.1 million, and with their savings, that meant they could look at a purchase price at about $1.225. In this scenario, they would have had to pay $50,000 or more in mortgage insurance. And even with this scenario, the client said to us that the purchase price wasn't enough to be able to buy what they wanted where they wanted. So we sat down with them and had a look at what we could change that might improve things. And really, there were two levers that we were able to pull, and we needed to pull both of them for this to work. The first thing we did was we used $100,000 of their savings to clear their HECS debt. That actually increased their borrowing capacity by almost threefold. So their borrowing capacity increased to 285,000. The next part was the parents were keen to help. They'd previously helped another child. They didn't have cash to give or to lend, but they did have a house with lots of equity in it, and they were more than happy to offer a family guarantee. So when we did these two things, what we found was they could now afford a loan of 1.4 million. With their savings of 50,000 that remained, that gave them 1.45 million to spend on a home, which meant a purchase price of 1.36 million. So that was in the range of what the first home buyers felt they needed to buy. It meant that they would avoid $50,000 worth of mortgage insurance. So this was a real win in their mind. And to understand how this gets presented to the bank, we set up lending so that of the 1.4 million, 1,088,000 is secured against the home that the first home buyers buy, and that represents 80% of that home's value, which is the maximum limit of what banks will lend without mortgage insurance. And the balance of what they borrow, the 312, is secured against the parent's home. Now, in time, as the loan is paid down or the property value goes up, the first home buyers will be able to release the guarantee, and the parent's home will then become free from that. So it just shows you where family guarantees can help a great deal. So that's what I wanted to present and share today. And now would be a good time, if anyone has any questions, to share those with us. And I'll just wait and see what comes up in the chat. But whilst we do that, David, I'm seeing a lot of first home buyers come to me who say they can't afford to buy where they want to live and are interested in this idea of rent vesting. Could you perhaps talk to us about what that is and what your thoughts on it are?
Yeah, I think so if they're based in Melbourne, Tim, you would hope that they could afford something because, 1 2-bedder apartments, depending on the geographic location, are starting at 400 grand, right?
Yeah.
And that's almost the cheapest real estate in the country. There's not too many places now that are under 400 grand, just period. So, with rent vesting, the entry point would probably be 400,000. That's the first point. The theory of rent vesting is if the market that you're living in doesn't show value, you should look elsewhere to rent vest. Now, for those living in Melbourne at the moment, which I think is a lot of FMD clients, they probably should just be buying in Melbourne. And if they can't afford to live in that property, they should just rent it out.
Mm-hmm.
Right? So let's say let's do a random example. So let's say they grew up in Camberwell and they can't afford a unit in Camberwell. That's fine. Perhaps maybe buy a unit in Burwood as a rent vesting product, and then maybe they live in it, maybe they don't. The benefit, of course, if they then live in it, is they'll get the growth capital gains tax free, right? So yeah, that tax is important. It does come into it, does erode the wealth building. So we have a rent vesting article that we can share, which talks through the nuances of that, which I can share with you, Tim. And if you want to send that out to the wider group, that's fine.
That would be good.
Yep.
And we get a lot of first home buyers who are very adamant that they need to buy a property with land and that apartments are no good as an investment.
Yep.
Could you perhaps address that and explain how that sits?
Yeah, sure. So there is no question that long-term houses do better than apartments. No question. And in fact, our study since records began show that houses will outperform units by about 2% compounding per annum, right? So if your strategy is to buy, hold, and never sell, you should always buy a house, always. But for most people, practically, that's not the case. They're not going to buy this a piece of real estate and never sell it. Usually they're using it to trade on to the next piece of real estate, right? And right now, for example, in the short term, define the short term by the next 6 to 9 years, we think Melbourne houses could grow 50%, and we think Melbourne units could grow 70 to 90% in this cycle. Right. And obviously that changes through time for various circumstances. Units absolutely do grow. We have a white paper that we've published to show that all units in all markets go through growth phases, and there's been multiple unit growth phases in all markets. And in some cases, unit growth's been up to 300% in one cycle, and in other cases, 150% and 120%. So I think to round out that question properly, if your intention is to buy a piece of real estate and never sell it, you should always buy a house. If your intention is to, buy a piece of real estate to trade into the next, depending on your budget and depending on the timing of when you do that, it might be more appropriate to buy a unit. Now, when you buy a unit, you are buying what we call a land content rich unit. So a granny flat, one of six, something with high land value content. We would never buy high density ever. There's just no point to doing that. We wouldn't buy medium density. So when we talk about units and trading units, we're not talking about, all the units that have gone through horrible corrections. We're just simply talking about those that are attached to high portions of land.
Beautiful.
Yep.
I've had 3 questions come in all relating to the lending side of things. The first one was a query about the Victorian First Home Buyers Fund. For those that are unaware, this is a program where the government, in effect, becomes a co-owner of property with the purchaser, and it's now being rolled into a federal program. It has its place. It certainly is useful where your borrowing capacity isn't strong enough to get you into something that you are looking for or need. The downside is that it's really tightly controlled in terms of the criteria to be eligible, and it is a program where you have to review your entitlement to be part of it annually, and it can put you in a position where you may need to buy out the government or sell the property at a point in time that doesn't suit you. So I haven't yet met anyone who's using the program, which probably is the biggest indicator of how valuable and successful it is. The next question we have was about any government benefits for second residential property and also government benefits in New South Wales. I'll have to take the second part offline and come back to you on that. But government benefits for second residential homes generally don't exist. There is a small exception where the last time you owned property is more than a decade ago and you're a single parent, and there are some concessions around there to help people back into the property market. Joy's asked a couple of questions. How does the first home loan program work at 95% when the banks won't loan more than 80? No, the banks will lend more than 80. It's just that normally they would charge mortgage insurance, so they'll let you borrow to 95 and avoid mortgage insurance. But in the case of the 5% deposit scheme, in effect, the government pays the mortgage insurance and guarantees, or it doesn't pay the mortgage insurance, it guarantees the loan. So that is how the banks can avoid having to charge mortgage insurance. The government's standing behind the loan to give the bank the security and confidence that it needs to lend. And Joy, you've also asked, all well and good talking about a home priced over 1 mil. Not many can even think about that. Please talk about homes in the 600,000 to 800,000 range. David, do you want to comment on, do you need to be spending more than $1 million to get a good investment?
Well, I mean, the majority of the work that we do is under $1 million from an investment standpoint. But unfortunately, houses almost everywhere, not everywhere, in the markets that we like at the moment are over that $1 million. It's just the way of the world. I mean, if you go out into the house and land package areas of Melbourne, you can buy stuff for 700,000, 800,000. But that is on the absolute fringes of, the new house and land package estates. So the commute to the city is incredibly long. It's just where pricing is at the moment. I mean, that's what it actually costs to buy a parcel of land and build a home. It's in excess of 650 now. That's without everyone putting their margins on. So unfortunately, it's the world we live in. For those people looking under $1 million, usually a unit is more suitable because it's better located in terms of amenity, and all the the things that they need to live and function are typically closer into the city.
Okay.
Yeah.
That's the last of the questions that we have. If you have any questions that come to mind after today, please don't hesitate to shoot an email through to myself, or if you're an FMD client, to your advisor, who will no doubt pass them on to me. And thank you all for tuning in today. Thank you to David for joining us and sharing his wisdom. That is all for today, and signing off.
Thanks, Tim.